Well, we know the Fed keeping a close eye on inflation. The latest report that we just got this morning, inflation easing in March for the 9th month in a row. This is according to the latest CPI report. Now, prices were up 5% on a year-over-year basis. That's the smallest gain that we've seen in nearly 2 years. So while this might be good news here for consumers and the Fed, there's still a long way that the Fed needs to go in order to reach its 2% target. Joining us now is Paul Krugman, a New York Times op-ed columnist. Paul, it's great to see you here. A lot to unpack. Let's first start with this CPI print. Inflation cooling once again in March. What do you think of the report?
Well, it was, at these days, there are enough different measures of underlying inflation that you can be an optimist or a pessimist depending on your personality. There's just this amazing ability to pick what numbers you like. But when I look at it overall, trying to extract the signal from the noise, it was another good report. Not great, but if you look, probably underlying inflation is something like 4% or less. Different people will give you a different number, but down from maybe 6%. In early 2022. So we're seeing a steady process of falling inflation in spite of the fact that the unemployment rate has actually gone down a bit instead of up. So it's actually it was kind of a, for those who were hoping for a soft landing, this was a reasonably encouraging report.
Nice to see you, Paul. And you tweeted about immaculate disinflation, a wonderful term, big fan of that, which is where we won't see a dramatic increase in the unemployment, but we will see disinflation. Is that long-term, your projection?
Well, there's two questions. One is whether it's possible. And so far, the data keep on saying that it is. Again, we've had a notable reduction in inflation without any rise in unemployment. The other is whether they can pull it off. And this is where, the fact that the Fed is kind of predicting a recession, it's quite possible that they will end up having generated a recession that we didn't need. So, inflation's coming down. We haven't had a rise in unemployment, but the Fed is projecting unemployment of like 4.6% by the end of the year. They seem to be forecasting that. And then the question is, well, is that, why are we doing this? Which I think is what Austin Goolsbee is in effect saying.
Paul, do you think it is time for the Fed to back off, that the Fed should pause at this point?
I think so. I think it's getting harder. There was a time a year and a half ago when people who were inflation optimists like me kept on looking for excuses to hang on to our optimism in the face of bad numbers. Now, very much the shoe is on the other foot. People who want to be inflation pessimists are, the Fed is using narrower and narrower measures. It's kind of one-eyed bearded man with a limp measures of inflation to suggest that we are not actually seeing improvement. But most measures do say that things are better. And I think we'll get a little more data later this month, employment cost index. But I think right now the Fed should say, are we sure that we haven't already won this war?
One of those pessimists is BlackRock CEO Larry Fink says he doesn't see how inflation is going to go anywhere near 4% anytime soon. Your thoughts on his projection?
Gosh, that's really surprises me, because if you take out the stuff that we know is temporary, take out shelter, where we know that's a way lagging indicator, mainly take out food and energy, which are always highly volatile, and take out used car prices, then the inflation rate is about 4% right now. How, on a 3-month or a 6-month basis. So why he would be saying that it's somehow very hard to get to, where by the measures that I and other people I talk to look at, we're already there.
Paul, I know in the past you said that the market might be a little bit too confident, might be getting ahead of itself in terms of what it's pricing in for the Fed to eventually cut here by the end of the year. That was a couple months ago. Is that still the case?
Well, the markets are a little more pessimistic than they were at their most optimistic. Two things. One is from what I'm seeing, the banking crisis is not blowing over completely, but has been a lot less than people feared. So there doesn't seem to be much reason. And the economy. Two things: the economy. I just don't. The economy seems to be chugging along. The market is in effect pricing almost panicky rate cuts by the Fed, and that does not look like it's about to happen. Maybe, God knows, but it is kind of amazing how much the market seems to believe that the Fed is going to have an "oh my God, what have we done" moment, and that's not what I'm seeing in the data.
Good to hear. All right, want to get your thoughts on Yahoo Finance speaking with IBM Vice Chairman Gary Cohn earlier, who expects AI to be transformative for worker productivity. Want to get your thoughts on this. Listen.
It's not going to happen overnight. Just like the laptop, the first version of the laptop computer didn't have a instantaneous effect, but as it got better and better and faster and more software was written, it became a really productivity enhancing tool. Machine learning AI, we think, will have enormous impact on the productivity of the U.S. labor force. And it will allow people with different skill sets to be much more effective at what they do.
And on your recent op-ed, you said it will be some time before we see any major impacts from the technology. Why is that? What kind of changes do you expect it to bring to our workforce?
Well, we're going to have to, I think it's a reasonably good forecast that it will change the way we do work. It'll change the office a lot. There's the question about whether machine learning, all this stuff is genuinely artificial intelligence, but it will replace a lot of work that is now done by human beings, and so we will definitely have a reshuffling of the office in 2040. Will look quite a lot different from the office in 2023, and so will be, people will be doing things differently. It always takes time. Again, the microprocessor was introduced in 1971. In the end, it changed a lot of stuff, but you didn't see it in the productivity numbers until around 1995. So these things take a long time to show. And also, how I think it's interesting that he uses the laptop, because the laptop, IT did produce a productivity bump. We got 10 years of accelerated productivity growth starting around 1995, but only about 10 years. And if you look at the last 25 years, it's actually been, you wouldn't know that there'd been any major technological breakthrough in that period. So I think it's still very much an open question whether this is going to make a big difference to the economy in the long run.
So could see a spike and then eventually another flatline. Paul Krugman, great to see you, sir. Appreciate all that.